Hello everyone and welcome to Markets with Markus. Did you know that you will soon own a share of Robinhood and the crypto world? And maybe a bit less of the bond world than you were thinking? And we'll have a look at where bonds ended today later in the update as well. So the S&P reshuffle. On Friday, after market close, S&P announced that 6 names will join or leave the S&P 500 on September 22nd. This will be 3 newcomers and 3 leavers. So many of us in this community own S&P 500 funds. It's a good way of investing in a diversified way in the stock market. So these changes will affect us and how our investments will perform to a certain degree. Now, it should not really be a game changer. As we all know, the 7 large tech companies, the so-called Magnificent 7, still drive 30% of the S&P alone. So these new additions will initially only make an impact on the margin, I think. But it may not stay that way. And it's also good to see where markets are going and what the current trends in the economy are. For example, whether Robinhood joining has a wider meaning for the economy in terms of crypto, bonds, and online trading. We'll get back to that a bit later. So, Robinhood is an online broker. They don't have any branches. They really focus on trading in equities, futures, and options. They do crypto and they do banking. In banking, it's mostly deposits and credit cards, no lending. They were founded in 2013 and initially became famous as one of the first large brokerage firms that offered zero-commission stock trades. Was also heavily advertised, gave them a good name. To that, they added a few years later, in 2018, crypto, again, one of the initially best-known names in crypto, and still a very well-known name. In 2019, banking came, and in 2021, they listed on NestEgg. So with their elevation into the S&P 500, Robinhood joins the elite circle of American finance, so to speak, and is now together with JP Morgan, Goldman, Morgan, and Schwab, really in this exclusive club. There are other firms, except for Robinhood, who have crypto exposure as well in the S&P 500. Most notable is Coinbase. That's basically crypto only. Coinbase is essentially a crypto exchange and crypto custodian. But you have other names as well, like Block, formerly Square, or the large IT providers who sell their equipment to cryptocurrency buyers as well. But in a way, Robinhood, the question is, as we said at the beginning, does it validate the online brokerage model? Probably yes. Does it have implications for wider recognition of crypto? Hard to say, but definitely it shows that it's not a hindrance anymore for being accepted into the S&P 500. So when S&P announced that they would add Robinhood on Friday, the stock jumped, and at the end of trading today, it was 16% higher than before the announcement. And Robinhood is now worth $103 billion in market capitalization. On to the next addition to the S&P 500. That's AppLovin, ticker APP. It's an advertising solution for mobile apps. Essentially, they sell to other businesses to help them find advertisers and share the revenue for advertising. So it's not really a household name. When their addition to the S&P 500 was announced, their stock also jumped. It was up 12% as of close of trading today. And they're now worth $185 billion, more even than Robinhood. And the third addition to the S&P 500, that's MCOR Group. they are an interesting case. They are a construction and facilities firm. And their core offering is that they build and manage data centers that clearly have been a good business for a while and are currently also experiencing a bit of a boom with AI. So the data centers themselves are not owned by EMCOR. They're very capital intensive, they're expensive, requires a lot of money. So usually the ownership of the data centers themselves sits in a fund, in an ETF, in a REIT that some of us probably own as well in this community. But they build them and continue to operate them. That's their business model. Made them a member of the S&P 500. But the market was a bit more skeptical than for Robinhood and AppLovin. Their share price is actually slightly down, you could say almost flat since the announcement, minus 1% at the closing of today versus before the announcement. And they're worth $28 billion. Now on to the levers. And the first one is again an interesting case for our community here of bond aficionados. Market Access Holdings is an electronic trading platform for fixed income, so bonds including. That is in itself not a bad niche. No? As many of us know, as we explain in our courses, most bonds are not listed on any exchange but traded in what's called over-the-counter, so directly between market participants, meaning professional market participants, banks, brokers, traders, who sometimes use private platforms such as Market Access, or they just call each other up on the phone. Over time, this has been increasingly moving from talking over the phone to electronic platforms. So it's a business that has been growing volume-wise. And indeed, Market Access reports at the end of last year that their volumes have been growing, that every day they trade 22 billion on average in bonds. Those are good numbers, I think. But the business is very competitive. There's pressure on the margin. And the profitability just isn't there or is not growing as fast as for the three joiners. So if you look at the numbers, Market Access is only worth $7 billion, and the share price didn't really move since the announcement. So the $7 billion price tag probably explains why they had to leave the S&P 500. It's just not very much compared to the new joiners or other firms in the index. And that the share price didn't move, at least showed us that they didn't get punished too much for leaving. Normally, you assume when a firm joins the S&P 500, the stock price goes up, as we saw for Robinhood, AppLovin, because people have to buy it, funds have to buy it, become more prominent. And if a firm leaves, normally the expectation is that their stock price should go down. But as we see in this table, it's not always that precise. Now, a lot is also what people, what traders, what investors think about the individual firm. So, long story short, Market Access will be leaving. The stock market doesn't like it, doesn't punish them. And it really, I think, in my opinion, says not much about bonds as an investment per se. It tells you more that providing electronic platforms for bond trading is just not such a great business. It's very thin margin, very competitive. And speaking as an investor now, that may not be the worst thing for us here in the community, because now every cent that Market Access or other platforms don't earn is a cent that I as an investor don't have to pay. So not great for Market Access, but was not a catastrophe. Their stock price was stable. Good for us as investors. Maybe confirms that bonds are a good investment because they have low transaction costs and can be traded efficiently and cheaply. Then two quick notes about the two other levers that will go out of the S&P 500 on September 22nd. First is Caesars Entertainment, like Robinhood, one of those names that are well known or better known because they do advertising, are known to retail customers. They own, among others, Caesars Palace, a big hotel and casino in Las Vegas. But they're only worth $5 billion now. So similar to Market Access, just too small, they have to go. Again, the market took it in its stride. the share as of the end of today is basically flat to before the announcement. Caesars Entertainment is also performing weaker than other casino and hotel operators, so it's also a bit their name that is being on the line here. And finally, the third lever is Enphase Energy. We see here that's the only company who really got punished a bit, if you want, for having to leave the S&P 500. They're down 2% since the announcement. Their market cap is now only 5 billion. So they're a solar energy and storage company. That is clearly an industry that is facing some headwinds. They had a good boom. That seems to be coming to an end, or at least to be slowing down. They also seem to have their own issues in their company. So probably also not too much to read into it. So if we conclude our update about this reshuffle, I think it reflects overall broader economic trends, not too surprising, especially the dominance of the tech industry in the US economy, which is still seen as the future as growing, especially Robinhood up Lavin, shows that someone like Robinhood with a new business model with crypto exposure can benefit from the inclusion in the S&P 500 and probably the acceptance that means in a way. But we shouldn't overinterpret those actions by S&P either. The leavers generally didn't get punished too much in their stock price for having to leave. And a lot is also not just the market overall, but also the individual companies. Some do better, some are better known, some do worse. So we'll see how that goes. And as we always say, no one can predict the future, but it's always an interesting snapshot to look at. Let's now move on to a quick look at how markets did today. The first day, clearly, that the markets could digest all these changes. So stock markets were slightly up today, very slightly. You could almost say flattish in the big picture, but slightly up. And the main interpretation is that is because the markets were expecting rate cuts, or are expecting rate cuts. Those rate cuts, or this expectation of rate cuts when the Fed meets next week, also meant that investors were buying bonds, and bond prices rose. More demand, prices go up, and always remember, price up, yields down in bond land. That means yields for bonds went generally down, and for treasuries, yields were essentially or actually down across all maturities. Every single T-bill, T-note, T-bond had slightly lower yields today than on Friday. Again, a reflection of the demand the people were buying into them. In that respect, we also got a member question from JNG. I read it. If short-term rates are going down because of Fed cuts, any thoughts as to why long-term yields have also gone down 25 basis points last week? That seems to be a new pattern. So, and if this question sounds a bit cryptic to you, I need to give you a bit of background. We had a live last Friday, some of you may have seen it, where we discussed that long-term yields are not directly controlled by the Fed, but really by market expectations. And we had a bit of a little case study, look back at the last 3 rate cuts by the Fed. It was in the fall of last year when the Fed cut rates by 100 basis points, 1 percentage point overall, in 3 steps. And interestingly enough, surprisingly enough, last year, every time the Fed cut the rates, short-term yields for T-bills went down, as expected, but long-term yields, everything 2 years and up, kept rising. And the interpretation of that, my thoughts about that are that last year the market liked those rate cuts and assumed the rate cuts meant business climate, business would improve. And maybe they also expected a bit more inflation. Market doesn't always tell you exactly what they think. But essentially they kept bidding up the long range, a sign of confidence, a sign of fear of inflation. But that's what it was. So the Fed hasn't cut rates yet this cycle. That is probably, nothing is sure before it's done, but that's what's probably going to happen next week. So we'll see what happens when the cuts actually come. But what's happened on Friday and today is that long-term yields were down together with short-term yields. So the best explanation is that people were buying across the board to lock in those rates, which can only mean or should only mean that market participants, traders, investors like you and me, were trying to fix those rates before they go down, which probably means, especially in the long-term rate, that people expect a slowing economy, maybe even a recession, and seem to be less afraid of inflation. Now, if you were afraid of inflation, you'd probably not buy at these rates. But if you expect a slowing economy, maybe a recession, still see treasuries as a safe haven, then you would buy at these rates, lock them in. That's what seems to be happening. But no one knows. We'll keep watching this space for you. Keep following our channel, keep following our updates in Markets with Markus, and see you soon again with the next update later this week. Thanks a lot. Have a good evening.